Have you ever, like, I don't know, just stopped to think about what actually makes a business valuable? I mean, beyond, the hype of whatever the latest new technology is, like, what's at the core? What's the foundation?
Yeah.
That's what we're going to be kind of digging into today, this whole sometimes surprising relationship between technology and, lasting business success.
It's about separating the signal from the noise.
Yeah.
I think the sources that you pulled together for us do a really nice job of giving us a very grounded look at what actually creates enduring value. And I love that it's coming from the perspective of experienced investors and strategic thinkers, people who've seen it all,
Yeah, yeah. And it's an awesome collection of sources.
It is.
We've got Peter Singlehurst from Baillie, Gifford.
Oh, yeah. He's great.
Over on the 20 VC podcast, just laying down some serious wisdom. We've got the fundamental principles behind measuring the moat.
Always a classic.
And we've got the power packed concepts from Hamilton Wright Helmer's 7 Powers. And of course, no deep dive into business strategy would be complete without the strategic bedrock of Michael E. Porter's competitive strategy. Plus a really insightful article that you found about picking an industry.
Yep.
And a brilliant quote from Sam Lessin over on the Technology Brothers podcast. It's a rich landscape to explore.
It is. And I think each of these sources in its own way kind of gets to the heart of what makes a company not just get big, but stick around and thrive, right?
Yeah.
And so our mission, I think, in this deep dive is to pull out those crucial insights for you, the listener, and really equip you to look past the initial buzz, the novelty of a new technology, and pinpoint the businesses that have true staying power. And maybe more importantly, understand why just focusing on that technology itself can actually lead you down the wrong path.
So to kind of unpack this, let's start with a key insight from Peter Singlehurst.
Yeah, let's do it.
He said, and this really resonated with me. He said, "I'm not a student of technology. I'm a student of businesses and business models." Why is that? Why is that such a fundamental truth when we're talking about long-term value?
Well, I think his core insight there is about prioritization, right? I mean, even as a growth investor, someone who's often looking at these kind of tech-heavy, up-and-coming companies, he puts the emphasis squarely on the fundamental principles of a good business.
Yeah.
And technology is often the engine. It's the how.
Right.
But the strength of the business model itself, the what and the why, that's what ultimately determines lasting value.
Makes perfect sense, right?
Yeah.
I mean, you could have the most groundbreaking technology, but if you can't actually build a sustainable business around it, if you can't attract customers, if you can't keep those customers, if you can't generate profits, it's essentially just an expensive hobby at that point.
Exactly. And that leads to his point about the danger of simply using capital as your main competitive weapon.
Yeah.
He describes that as potentially leading to Pyrrhic victories, which I think is a great way of putting it.
Yeah.
You might win some market share in the short term by just outspending everyone else, right?
Sure. Yeah.
But if you haven't built genuine differentiation,
Right.
those wins can be very temporary and ultimately meaningless.
It's like a race to the bottom on price. Everyone gets a little piece of the pie, but nobody ends up with a healthy slice.
Exactly.
So if just throwing money at a problem isn't the answer, what should we be looking for?
Well, this is where the concept of sustainable competitive advantages becomes so crucial. These are the real differentiators. They're the unique aspects of a business that allow it to maintain healthy margins over time and achieve, attractive economics, making it a desirable acquisition target or a strong IPO candidate, right? It's about what makes a company special and difficult for others to replicate.
That connects directly with this idea of a moat, doesn't it?
Yeah.
This image of a strong castle protected by this, surrounding body of water, keeping the competition at bay.
Exactly. And measuring the moat as a book and as a set of principles, really underscores that for investors, especially those with a long-term horizon, understanding those competitive advantages, that moat, is absolutely essential to understanding why some companies can consistently deliver those high returns on invested capital. It's about identifying what unique protection a company has against its rivals.
So we're clear, just having, cool technology isn't enough. The sources really stress that That while these technologies, AI, blockchain, mobile, the internet, all incredibly powerful tools, they don't automatically create great businesses. The real value lies in what you build on top of those technologies.
I think what's fascinating here is this distinction between the raw technological capability and its practical application in a business.
Mm,
And you can get lost in these debates about, where does the core value lie? Is it in the foundational tech itself or in the specific way that a company uses it? But I think Hamilton Wright Helmer's concept of power provides a really useful framework to cut through some of that complexity.
Okay, power sounds like a key concept.
It is.
Tell us more.
So Helmer argues that power, which he defines as the potential to generate persistently superior returns,
Okay.
is the real engine of long-term value.
Mm.
And for a business attribute, often enabled by technology, to qualify as power, it has to possess three qualities simultaneously. It must be superior, it must be significant, and it must be sustainable.
Superior, significant, and sustainable. So let's break those down. What does superior mean in a business context?
So superior in this context means that the attribute actually leads to an improvement in the company's free cash flow.
Okay.
It's not just, a nice-to-have feature.
Right.
It has a tangible, positive impact on the financial health of the business.
Got it. It directly contributes to making more money. What about significant?
Yeah, so significant means that this improvement in cash flow has to be meaningful. It can't be a small, barely noticeable difference.
Right.
It needs to be substantial enough to really drive the company's overall performance.
Okay. And finally, sustainable. This sounds like the real test of power.
It is. Sustainable means that this improvement in cash flow needs to be largely protected from competitive erosion.
Okay.
In other words, it's difficult for competitors to easily copy or neutralize this advantage.
Yeah.
This is where the strength of that moat we were talking about truly comes into play.
This makes it much clearer. So a fancy new AI feature might be superior and even significant in the short run.
Yeah,
But if every competitor can just easily roll out a similar feature, in a few months, it doesn't represent true sustainable power.
exactly. Now let's bring in Michael Porter's 5 forces framework, which is another critical lens through which we can analyze competition and understand how technology fits into the broader strategic picture. You've got competitive rivalry, the bargaining power of suppliers, the bargaining power of buyers, the threat of substitute products or services, and the threat of new entrants.
Yeah, a foundational framework in business strategy. And I recall reading that Porter didn't believe technology should be considered, like a separate sixth force.
Right.
Why was that his perspective?
Well, Porter's argument was that the impact of technology isn't isolated or independent. Instead, its effects are always felt through the existing 5 forces.
Okay.
So, for example, technology might lower the barriers to entry for new competitors,
Right.
thus increasing the threat of new entry, right?
Hmm.
Or it might empower buyers by giving them more information and options,
Yeah.
thereby increasing their bargaining power.
Yeah, that makes perfect sense. Technology doesn't operate in a vacuum. Its influence on the competitive landscape is always mediated through those existing 5 forces. Now let's shift gears a little bit and talk about valuation. This is where investors really put their money where their mouth is.
Yeah.
The sources make a really clear distinction that you shouldn't directly factor technology into a company's valuation.
What's insightful here, I think, is distinguishing between the technology itself and the industry a company operates in.
Right. Right.
They give a great example of a logistics company
Okay.
that uses blockchain technology. While it utilizes, cutting-edge tech,
Mm.
its fundamental risk profile and competitive dynamics are going to be far more similar to other logistics companies than to, say, a company developing, the underlying blockchain protocol or a cryptocurrency exchange.
Yeah. Right. So when you're evaluating its potential, its inherent risks,
Yeah.
you should be looking at benchmarks within the logistics industry,
Yeah.
not necessarily comparing it to the often volatile world of crypto assets.
Precisely.
Yeah.
And the same principle applies to a company, heavily leveraging artificial intelligence. Just because a company uses AI doesn't automatically justify a higher valuation compared to other, software companies, for instance. Any premium in valuation needs to be supported by by a specific, sustainable competitive advantage that the AI provides.
Right.
And this advantage should be clearly evident in the company's overall strategy and reflected in their financial projections.
So it's not about the coolness factor of the technology. It's about the tangible, measurable impact it has on the business's fundamentals. The sources use the example of drone delivery. The end customer isn't buying the drones themselves.
Right.
They're buying the convenience and the speed of the delivery service.
Totally.
That's the lens through which you should view industry classification.
Exactly. And this leads us to how we should be thinking about and modeling the potential benefits of technology, right? Things like increased scalability, reduced operating costs, improved service quality.
Yeah.
These are all real advantages that technology can enable.
Yeah.
But instead of simply saying, we use AI, therefore our growth will be exponential.
Right.
These benefits need to be translated into concrete, quantifiable factors like projected revenue growth rates, customer retention metrics, and gross profit margins.
So you need to see that direct link between the technological advantage and how it actually drives those key business metrics. It can't just be a vague notion of disruption.
Right. And speaking of disruption, I think Sam Lesson's quote on the Technology Brothers podcast offers a really interesting perspective.
Mm-hmm.
He argues that even major technological shifts like the widespread adoption of mobile and cloud computing
Right.
were in many ways barely disruptive
Mm-hmm.
in terms of fundamentally changing the dominant market leaders.
That's a counterintuitive idea. You'd think those were seismic shifts that would have completely reshuffled the deck.
Yeah.
What's his reasoning there?
Well, his point is that while the technologies themselves were absolutely revolutionary, right?
Mm-hmm.
The established market leaders often successfully adapted
Right.
and maintained their dominant positions, just operating at a larger scale and with the new technology kind of integrated into their offerings.
Mm-hmm.
It suggests more of an evolutionary process than a complete upheaval in terms of who ultimately comes out on top.
That's a really important takeaway.
Yeah.
It cautions us against automatically assuming that every new wave of technological innovation will inevitably topple the existing giants and create entirely new sets of winners.
Exactly. And finally, the sources bring us back to the role of venture capitalists.
Right.
While they're often investing in companies leveraging, the very latest technologies,
Right.
their core expertise, even at that very early stage, is in understanding fundamental business principles and evaluating the strength of business models.
So even though they're on the cutting edge of technology, they're still fundamentally looking for those same sustainable advantages, that potential for building a lasting and profitable business right from the very beginning.
Precisely. They need to be able to look beyond that initial excitement surrounding a novel technology and assess whether a company is building something with genuine staying power.
Yeah.
And I think that's something we can all learn from, right?
Yeah.
Understanding how a particular technology translates into sound business principles.
Yeah.
That is the fundamental skill,
Mm-hmm.
regardless of whether you're a seed stage investor,
Right.
or managing a large public equity portfolio.
So to bring it all together for you, our listener,
Yeah.
the central insight from this deep dive is this: the true and lasting value of a business isn't solely determined by the novelty or the sophistication of its underlying technology. It's fundamentally rooted in those enduring principles of sustainable competitive advantages and robust business models. Technology is often a powerful enabler, a critical tool,
Yep.
but it's not the ultimate source of enduring value.
And this leads to a crucial question for you to consider.
Yeah.
As you look at the current landscape of technological innovation and all the surrounding enthusiasm,
Mm-hmm.
what are some specific companies that you see that are truly building defensible moats that extend beyond just their technological capabilities?
Mm.
What makes their advantage truly superior, significant in its impact, and most importantly, sustainable in the face of inevitable competitive pressures and future technological advancements?
That's a fantastic question to really wrestle with.
It is.
And we encourage you to take these concepts of competitive advantage and the strategic frameworks that we've discussed, and apply them to your own understanding of what makes a business not just successful today, but built to last in our rapidly changing world. Thanks for taking this deep dive with us.
Yeah, thanks for listening.